Hey everyone, Dan here. We are after market close on Tuesday, June 8th. Today we're going to do an update video on CLOV and the potential for a short squeeze. Before we get into it, if you enjoy these videos, please hit the like and subscribe button. It helps a lot. And let's jump right in. So CLOV has continued this big bump up today, pressing $25 today before selling off and nearly returning everything that it had gained during the trading day, at least, not during the pre-market hours, but then rallying back and making another run into the low 20s. And you see there's still a battle waging here. We're about, an hour after close. And so there's still a battle waging over here to see basically if this price zone can hold this 21.32. So, definitely good work from any of the retail investors that are trying in any way, shape, or form to keep the share price high in order to put pressure on the shorts. If we look at the short data from today, we actually didn't get updates here, which is unfortunate, but this is a free thing. This is a thing that somebody built that has a feed off of Interactive Brokers, so it is what it is, and there's nothing that can be done. We see as of close of day yesterday, the short volume ratio was as high as it had been at any time since the 24th of May, and certainly possibly well before that time. But short volume ratios in the 30s are very, very, very high. So I think for sort of like the squeeze to continue, and I think there is a lot of squeezing activity that's taking place, we may see that the ratio is still very high today once that data comes out. We may also see that the availability comes down quite a bit here from this 150K that Interactive Brokers had available. So it might appear that there's more borrowing coming out, but what might be happening is that some shorts are closing their positions, causing initial run-ups, alongside of retail going in and buying heavily. So the combination of those two of those things may be driving it up periodically, very, very strongly, but then at points, shorts may be opening up a lot of positions in order to try to get back into the play. So this is what I think is happening a lot of the times here. There's covering that goes on, and then they're sort of immediately turning around and reborrowing shares at a higher price point and saying, okay, I think that this is a better entry point. You can think of this similarly to when you sell out a position from a stock that you're losing money on because it's going down. Okay, you're holding shares and it's going down. Maybe it goes from 20 to 18 and you're like, oh, I need to stop the bleeding and just wait for this stock to start to turn around. So maybe you sell out of your position, take the loss, and then maybe you still really like the stock. Maybe it starts to show some price strength at 17, so you buy back in at 17. And that may have happened all within the same trading day or even trading hour, depending on the stock. So I think a lot of the similar thing is happening here. The shorts are covering to either lock in some very short-term profits or just get out of heavily bleeding positions. But then they're letting, as the stock runs up a bit from everyone closing out, they are re-entering short positions to try to claw back the losses that they had incurred on the previous short position. So that's what I think some of this that we're seeing right now is. Now let's talk a bit about what I put in the title of this video, which is the potential for naked shorting, and I do think the potential is creeping up. There's some critical data that we're going to have to just wait to come out, which will help shed some additional light on this. But let's talk about a couple of data points that are leading me to even sort of speculate that this may be possible. So I need to move this into frame so that you can see it. But basically here you see the volume for the day, 723 million shares traded. And here you see the free float. Oh, you still can't quite see it that well. Here you see the free float. Oh, it's still stuck there. Oh, okay, that works. So the free float, 110 million shares are in the free float. 408 million are outstanding altogether. So, 110 in the free float, and there were how many traded today? Where did they go? 723 million traded today. So yes, a stock can be traded several times in a day, and that can be how that occurs. But when it's, say, more than six times the volume of what exists in the float, that starts to kind of raise some eyebrows and say, are a bunch of the shares that are getting bought being naked short sold, and you're creating these essentially like fail to deliver stocks where somebody is buying a stock that's being short sold to them, and unbeknownst to the person who's buying it, the person that's short selling it or the broker that's short selling it doesn't actually have a stock that's being borrowed or lent out. It's a share that they're saying that eventually is going to come through in a few days as failed to deliver, and that share that the person owns who bought it is basically going to be turned into an IOU instead of an actually existing stock. And so this can obviously have systemic problems down the road, but this is one thing to really keep an eye on. Free float 110 million, volume well over 6 times that in the day. Okay, so that's one thing. But yes, again, for the people that are going to yell and scream that this can happen just because a share can be traded several times in one day, that is correct. Okay, this is a thing to look for that may indicate that there's other things happening besides just the same stock trading hands 6 or 7 times in a single day. We go over here and take a look at the institutional holdings. Okay, so here we have held by insiders 24%, held by institutions 106.24%. Now you say, how can there be insiders, institutions, and the public, retail? And we don't even have the number for retail here, but when you just have 2 of those components, institutions and insiders, that already accounts for over 130% of the stock. Shouldn't be possible, right? But basically, the way that this happens, I found a little explanation for us to try to make it simple, is short selling. So this is one of the ways that you can end up with well over 100% sort of existing in distributed shares across a certain ticker at any given point in time. So here it says, let's assume this company XYZ, doesn't matter, has 20 million shares outstanding, and institution A owns all of them. Institution B wants to short the stock, and so they borrow 5 million of the shares from institution A, and then they sell them to institution C. Now when it comes time to report on these shares and who owns them, A, because they've just lent them out, says, yeah, we own those. So B has to return those to us at some point, so we own them. But C, probably not even knowing that it bought shares that were being sold short, says, no, I bought it. It's mine. And it's not anyone else's. Like, I'm not going to give B back this exact share. So these are mine. And so in this way, both A and C claim ownership of those shares. And you then get, in this case, this 20 plus 5, you get 125% of the stock being owned or existing. And so that's how that can happen. But again, this happens with short selling. And we know that short selling is happening. But I would suspect that the institutional percentage being so high is being driven by the short sellers, and that the volume that we're seeing being such an outsized percentage of the float being an additional indicator that there could be fabricated, phantom, non-existing, failed to deliver shares that are being short sold, whether it's intentionally or unintentionally by the short seller, that ultimately are just going to become IOUs in the vast pool of shares that exist to the person who bought it, unbeknownst to them, maybe forever. And the way that this occurs, and I don't know if I'm going to be able to explain this in a way without like visuals that's going to come across, but just to be clear, what happens is I pay you $20 for Clover at whatever point it's trading at $20 today. You sell me a share, I think, but what actually happens is it takes T2 or T plus 3 to like 2 or 3 days to deliver that stock to me in reality. That's the settlement period. And so what can happen during that settlement period is my cash is already gone, right? That $20 already went to you. But there could be a situation where you actually say, hey, I encounter some issue and I actually can't get this stock to that person who bought it from me yet. What will happen then, because you don't want the entire stock market to ground to a halt just because somebody is having an issue that could be very legitimate as to why they're unable to deliver the shares in that 2 or 3 days. They're essentially issued, instead of truly the share, I would essentially have an IOU saying, as soon as that person figures out whatever they need to figure out and fixes the fail to deliver problem, that share is still coming to me because my money is already gone. But basically, there can be just a blind eye turned to those failed to delivers that don't ever get reconciled in the system, and that they build up over time. And if there was a really malicious player in the market, they could be doing this intentionally, selling people shares that don't exist, and then just failing to deliver on them intentionally. Now, I'm not saying that this is happening for sure, and even if it was, I wouldn't have any idea at this point who it would be. But I would keep an eye on these things. How out of control does the free float existence get from the volume that occurs in a single day? And when the next reporting comes out, which should have a May 31st timestamp on it, what's this percentage look like? Because that just sort of like gets us into the world in which there's clearly some over or under reporting going on that's causing anomalies to show themselves in the data. Okay, that's clearly something that's happening here. And then the thing I'm really waiting on is this is from the SEC website. This is the fail to deliver data. And what I'm waiting for is, right now there's just the first half of May in a zip file that you can get from them. I'm waiting for the second half of May because I think that will start to show the lead up to what we started to see just a few days ago, which was the beginning of June. So I'm going to be looking at the later dates in those files to see if there was sort of an increasing fail to deliver. And it will be quite some time before we get the first half of June. But when that comes out, that would show us like this exact time frame, what was happening right now. Were there a bunch of was there a huge spike in fails to deliver because potentially there was shares being sold that didn't actually exist, and so there was nothing to be able to deliver, whether it was intentionally done or not. That can certainly have a dramatically outsized impact on the stock. Now, if retail continues to show up, like they have the opportunity to continue to push this higher and higher, eventually those positions would have to be closed anyway, regardless of whether they exist or not. And but that's one of the things that sort of like concerns folks in terms of like the systemic failures that could trigger across the market as a whole, is there's all these FTDs, these phantom shares that sort of have to be, recognized and legitimized and acted upon by being covered. So I don't know if that made sense, but hopefully it did a little bit. This is just to say that I think that the situation with CLOV is getting extremely hot, extremely volatile from various angles, and there might be many, many more things at play than we have any clue about at the moment. But we need to keep our eyes peeled and do our best to try to understand and decipher the information as we go. And of course, I can always make errors in how I'm understanding something, how I am working my way through building sort of a hypothesis around something, just like with charting. So always, always, always do your own research, do your own due diligence. Don't just say, oh, Dan said this, and so this must be true. That should never be the case. I so often think something and think, is that even true? Like, I have a hard time trusting my own, hypotheses at times, because sometimes it feels like you get so far down a rabbit hole and you're kind of stringing information together because you don't have super high level transparency through the process, as you see here. So trying to stitch data together to try to figure out what could be happening, but clearly something's happening. I don't know if it's just a bunch of people in the retail sector deciding to jump on a thing and that's what's driving it up, but that could always be the case too. But I'm starting to think that there's more at play here, and I would encourage you to look at some of the data, understand what it is. And certainly if you come to a different understanding than what I presented here, please leave it in the comments, because to the extent that there's more accurate information that somebody has, or just an error, maybe a misspeaking that I may have made, I want folks to be able to try to quickly get the right information as soon as possible. So yeah, that's that one for now. What a week it has been. I mean, what a year it has been, really, with the ins and outs of all of these crazy, crazy situations. But, no matter what, it's really interesting to see what's happening. And I think a lot of retail investors are learning a lot from the different sources of data and things that they can pick up on, things they have access to that they maybe didn't know about before, and just sort of like what those things mean and how to sort of consume them and understand them. All right, I'll quit my rant there, but I appreciate you watching the video, and I will see you in the next one.